I think that the markets tend to anticipate. So, the markets try to predict the future. And what they're basically predicting is that there will be rate cuts.
Are they better than the economists who have predicted 30 of the last recessions when they only happened 6 times?
Economists, they always joke about the fact that they are as good as the weatherman. But at the same time, they sound great. But I actually think that this time there are a lot of signals that would say that there should be rates as we go through the year. The question is when they would start. And if I were the Fed, I would be a little concerned about starting too early because, yes, we're seeing the right direction of travel with inflation. I think the Fed is also expecting the direction of travel to moderate, meaning it's going to get harder and harder to kind of continue to bring the rate down. So they're going to expect that, which is also good. But they also want to make sure that they feel like they've really gotten to a state of stability around the rate before they start making significant moves in the interest rate space. So that would mean, I would say that I don't know when that's going to be. I'm not going to try to predict that. But the markets do try to predict it. And what happens in the markets as a result of this notion that there could be a lower cost of capital as you go through the year is that investors can start to think about how they model company earnings over the future more successfully. They can say, well, I know that the cost of capital is not likely to go up. So then I can at least put in a stable cost of capital as a foundational element of their model. They also know that inflation is coming down, so they also know that the cost of doing business is also moderating. So that also gives them more confidence. And if you're a borrower, if you're trying to do M&A or you're trying to expand your business, you also know your cost of capital as a company is not going to be higher. Like, so if you borrow now, you're not suddenly going to have to borrow at a higher rate later. So I think all of that builds more confidence in the market, which, of course, does show up in the market values. Well, last year it was a very, what I would say, top-heavy market performance that kind of brought all the indexes up. I think you're starting to see in December and into January a broader-based improvement in valuations because I think that the broader market, small caps are now starting to show some improvement in valuations and others because they know that the cost of capital is likely to be stable to lower going forward. And I think that'll also drive an interest in investors wanting to put risk capital to work, which means IPOs could have, we could actually have the IPO market open back up again. And we are seeing a lot of interest. We have about 85 companies who filed to go public on Nasdaq who are wanting to go out into the market. And so I think that they're starting to gain more and more confidence that that could happen in the first quarter or second quarter. Most likely more in the second quarter, but there'll be some bellwethers in the first quarter.